Hello everyone and welcome to today's Market Snapshot. My name's Craig Erlam, Senior Market Analyst at OANDA. Now I hope you've all recovered from the events of the last 48 hours. It certainly was a very volatile time in the markets. Of course, as we saw in the early hours of yesterday morning when it became clear that Donald Trump was going to win the election, we saw a massive sell-off in the markets. At one stage the Dow was down around 700 or 800 points. It did recover later in the session and actually ended the session up around 250, 300 points. I mean, that's a huge swing. It's extremely rare that you tend to get this kind of time of kind of turbulence in the markets. Not this necessarily this kind of turbulence, but this kind of reversal. I really do think this was effectively Brexit on speed. At least in June, it took a couple of days for the markets to recalibrate and find some direction. But this happened literally within a few hours. I do think that potentially traders were looking at what happened in Brexit and tried to effectively get ahead of the game, and that may be what helped spur the markets on. It was obviously also triggered as well by Donald Trump's speech after the result was announced. Obviously, the initial selling is driven by the fear that we're going to see trade wars with China, we're going to see trade pacts torn up, we're going to see protectionism, but I think his speech really did take some of the emphasis off of this and onto some of the more positive aspects of the campaign. So wanting to unite the country, and the fact that he talked a lot about the fiscal stimulus measures that is going to do, the infrastructure spending, etc., the deregulation that they want to do to help the banking system, the fact that he wants to, all of these measures really are market friendly, and that's, I think, what spurred that initial reaction in the markets. And then once people started to see the market going, I think they effectively just hopped on board, and I think we just effectively saw the Brexit effect, but in a fraction of the time. But either way, that was a strong rebound in the markets, and we're continuing to see them push on higher today. It was actually quite interesting that that throughout this we did see rate hike expectations actually change quite considerably over the course of the day as well. You can see here on the Fed Countdown, the FedWatch tool on the CME Group website, that rate hike expectations currently are now at 81%. They were at around 81% before the election, but during the election they actually fell to around 50%. And the driver behind this really was the fact that you'll remember that the Fed has a dual mandate, which is currently close to hitting. The dual mandate is inflation and full employment. Inflation, as measured by its preferred measure, the core PCE price index, is currently at 1.7% and has been edging higher for a while. And also we're now seeing stronger wage growth. We've got the strongest wage growth we've seen in years. The latest wage data showed 2.8% year on year, which is likely to contribute to further inflation further down the road. We've also got unemployment of 4.9%, so this dual mandate is going well. But we also know that the Fed doesn't like to raise interest rates at a time when we're seeing extreme market turbulence. We've got plenty of examples of that over the last 18 months. Last August, the Fed was lining up its first rate hike in almost a decade for September, or so the market thought. We then saw a big sell-off in emerging markets, and in particular China. And the volatility caused throughout the markets was very considerable, and that appeared to deter the Fed and forced it to hold off until December. We then got that rate hike, and again in January we saw a lot of market volatility, the devaluation of the yuan, spurring fears that we were going to see capital outflows from China, and that we were going to see a slowdown. Talks of a hard landing and the sort started to appear, and again we saw a major market sell-off at the start of this year. From then it seemed to push back the next rate hike of apparently 4 to June, and we all know what happened in June. We saw Brexit, severe market turbulence for the week or so after, and then the Fed decided that they wanted to hold off for a little longer to see what the impact of Brexit would be, and of course let the market to calm down. And then obviously in November we've had the US election. Now when we started seeing all that turbulence, the Fed When we started to see all that turbulence, I think the market anticipated that it would be enough to deter the Fed, especially if it became prolonged turbulence. And in fact, it's actually, like I say, it's reverse stabilized, and we seem to be pushing on again. And once again now, the Dow is opening very shortly, and it's we are expecting, actually it's just opened, and I believe it may have just set a new all-time intraday high, which is quite remarkable when you consider that it was due to open around 800 points down yesterday following that election. So the Dow's just opened at a new all-time high. That says everything you need to know, really. So we're not seeing this volatility, and we are seeing some stability and positivity in the markets. Now, speaking of the Fed, we may as well touch on today's key market events. Very quiet day. Tomorrow's like to be very quiet as well. It's Remembrance Day, so you've got bank holidays in the US, Canada, France, and other areas as well, although the US markets themselves are open. We've had two speeches from Federal Reserve speakers today, Bullard and Williams. We've only just had the prepared remarks from Bullard. Makes no mention of the US presidential election, just says that he thinks that we should have one rate hike and then a prolonged period of none. So that again would lend its hand to a December hike for this year. We've had jobless claims which were broadly in line with expectations. And aside from that, we've had very little in terms of any notable economic data. Again, tomorrow is likely to be quite similar. I think really the markets need a couple of days to absorb what's truly happened in the last 48 hours, so I don't think it's necessarily a bad thing. I don't think it's going to lead to a lack of market volatility, if I'm perfectly honest, and especially if today is anything to go by now. Let's take a quick look at some markets here. Once again, we've got euro dollar breaking lower today, so it spiked all the way up to around 113 before pulling back. We're now right back at 108, so you can't say we haven't had any volatility around this event. You've got some support here around 108.50, which is where it ran into a bottom around towards the end of last month. If we see a break below there, then we're looking back at these 108.20s and below here around 107.75. But the first test here is going to be that 108.50. And if we break below there, then it would potentially indicate that the markets really are increasingly pricing in that December hike, now that the one major obstacle that was still remaining for the Fed, being the presidential election, has now passed with relative calm in the grand scheme of things, of course, not including the intraday volatility. Cable, we're continuing to see it edge higher. You'll see that, of course, the euro is actually falling against the dollar because we are seeing some broad dollar strength, but I think the pound is starting to enjoy some of that rebound. It's of course been helped along by Mark Carney and the Bank of England acknowledging that there's unlikely to be a rate cut anytime soon because the economy's performed better, more in line with expectations. We could see this spur the pound on a little bit higher on the back of this a very long overdue correction of some kind. We've had considerable softening of the pound since it was trading before Brexit. You'll remember up at these 150 levels, now down at the low 120s. I think a minor correction wouldn't do it any harm. Maybe back towards 128 levels here, where we've got this couple of the 55 and 89 simple moving averages and a prior level of support would make a logical resistance, and that's if, of course, we break through 125.50 in the near term. Dollar yen, we are surging higher. We did spend a little bit of time below the cloud, but we didn't close below there, and that was driven by that initial volatility on the back of the Trump election. Instead, we've surged back above. We're trading around 107 now, and I think this is your zone of your next zone of resistance. You've got 107 to 108 around that level. But you've got that prior high around 107.50. So prior resistance around 107.50, and then you've got the two moving averages here between 107 and 107.8. So we'll look for potentially looking at to see if we see any signs of the pair running into resistance here. Looking at the stochastic and the MACD, it looks like the momentum's with the move. So I think this looks as though we are going to see a move to the upper end of this range because it doesn't look at this stage like we are seeing too much holding it back. Brent crude is still continuing to look weak. We saw weakness yesterday in the risk aversion phase of the rally when we saw it pull back when risk returned. You've got to remember this isn't just a fundamentally oil-driven story, it is also a risk. It can also be a risk-driven story as well. We are basically seeing some consolidation here following what has been quite a considerable sell-off. Notable support here coming around the 43.30s from the lower end of the moving average range, but the entire moving average range really is providing some significant support. Of course, this coincides as well with this period of support here from around 45 and then the low end around 43, which again is another notable zone of prior support. Similar in WTI crude. We've got the moving average combo here coming in to provide support around 43 and between 43 and 42, and again these are both previous levels of support and resistance, so I think this is going to be a very important zone. At the moment it seems that it's survived the first test. Gold obviously very volatile. We broke all the way up to 1340, 1350, which is again, as I've said before, gold tends to move often, or not tends to, often moves in these blocks of 50, 1200, 1250, 1300, and so on and so forth. We broke through to 1340, we fell just shy of 1350 on this occasion, but you can see this clear resistance in normal trading times around 1300, which if we do move higher, I'll be keeping a close eye on. We were trading slightly higher earlier on in the session, but it seems that there is a lot more downward pressure to come on gold. It's not surprising considering we are pricing in a rate hike from the Fed. Trump presidency does increase the possibility that the pace of tightening will be faster because he intends to do this fiscal stimulus. He wants to get growth up from around 2% to 4%. These do tend to bring with them inflationary measures, and I think people are potentially we're potentially going to be seeing a steepening of the yield curve in response to that, which not a steepening of the yield curve, sorry. We may start seeing a more of a flattening of the yield curve in response to that. In other words, people indicating that we are likely to see rate hikes sooner than we were anticipating prior to Trump getting elected. We're also in this risk-on environment, so between risk-on, stronger dollar, higher rate hike expectations, these tend to be bearish for gold, and that's exactly what we're finally seeing, which it took a while into this session before we started to see it. Of course, we had that big retracement off the highs there. Got support here around 1260, which was support really since the 21st of October. If we break below here, then 1250 is going to be key. A break below here is very significant. I think that could signal a move back towards these 1200 zone. Finally, I just wanted to point out a couple of indices. We've got the DAX, which has pulled back from its session highs today. I think the reason why we're seeing a pullback in European markets is for technical reasons. We've got the CAC and the DAX both trading around their 2016 highs. You can see that the first time we were trading around here this year was actually at the market open on the first trading day of the year. We tested this level again in August and again in September, once again in October, and now it's our turn for November because we seem to like to do it just once a month. And we've come up to this level and we're seeing some profit taken, I think, off of these highs, and the same can be said for the CAC. Now that we've broken higher again, I think this trend line becomes pretty invalid. I think we've got quite a clear established trading range for now, around 10,200 to 10,800. A break above or below them could be quite significant. And then just to show you what I said earlier about the Dow trading at new all-time highs, just as we finish up. And there it is. We've just broken beyond new all-time highs, currently trading at 18,757. For more in-depth news and analysis, check out OANDA MarketPulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has got a lot of great tools designed to help you with your trading.